Next, we're going to take a look at how individuals make their tax payments. The tax liability is generally paid throughout the year through withholding tax payments that are deducted from wages if you're an employee. And these are the wages that are reported from your employer on your W-2 at the end of the year. Low-income taxpayers may also be eligible for the Earned Income Tax Credit, and we'll discuss that in Chapter 9 with our other tax credits. An income tax return is used to settle up with the IRS at the end of the tax year when you file by April 15th. When you're filing your income tax return, taxpayers will either owe the IRS, meaning that your tax liability is greater than the payments that you've already made, or you'll receive a refund, meaning that your tax liability is less than the payments that you've already made throughout the year. So let's take a look at an example of how tax payments are handled. So we have Arno and Bridget. They are married and they have combined W-2 income of $82,942. They received a refund of $353 when they filed their taxes. How much income tax did their employers withhold during the tax year? Well, when we take a look at the tax tables for a couple that are married filing jointly with income of $82,942, we'll see that their tax liability for 2018 would be $10,123. We're going to add the refund that they received, $353, meaning that they overpaid their taxes by that amount. So we will then calculate that they had $10,476 that were withheld from their paychecks during the year. So the next thing we're going to talk about is tax authority. So tax authority is the body of law, regulation, and precedent that guides taxpayers, the IRS, and the courts in application of tax law. There are three primary tax authorities. We have statutory sources, and administrative sources, and judicial sources. The statutory sources of tax authority are the 16th Amendment to the Constitution, which in 1913 gave the Congress power to tax the citizens of the U.S. The Internal Revenue Code that was passed by Congress and signed into law by the President, and any amendments and changes to that Internal Revenue Code that are made, the last one being the big one that was passed in 2017, and also committee reports from the tax law process. So when the IRS is creating their forms and creating guidance for the new tax laws, they'll go back and take a look at the committee reports from Congress to see how the lawmakers intended for that law to be applied. The administrative sources of tax authority in order of strength are Treasury regulations. These are the IRS regulations, and these are published by the IRS and will explain the tax law more thoroughly, and will also give some examples of different types of situations and how the law would be applied to those. Next, we have revenue rulings. These are rulings that are published by the IRS. Revenue procedures typically apply to internal procedures for the IRS. Private letter rulings are letters that a taxpayer can request from the IRS for guidance on how a tax situation would be looked at by the IRS, so that the taxpayer would have some better guidance on how to file their taxes properly. And also IRS notices. So these are notices that are sent to individual taxpayers. Both the private letter rulings and the IRS notices would apply only to that taxpayer that receives them. Next, we have the judicial sources of tax authority. If there are any disputes between taxpayers and the IRS, it would be up to the courts to resolve those disputes. The initial court of jurisdiction is going to be either the tax court, and they, of course, only hear tax cases. And the special thing about the tax court is that the taxpayer does not have to pay their taxes that are assessed before trial. And also the U.S. District Court and U.S. Court of Federal Claims. With the latter two, the taxpayer must pay all the taxes that are assessed and sue for a refund through the court. The tax court and district court rulings can be appealed to the U.S. Court of Appeals and then to the Supreme Court if the Supreme Court decides to hear the case. And the U.S. Court of Federal Claims rulings can be appealed to the U.S. Court of Appeals Federal Claims and then possibly to the Supreme Court. So lastly, we're going to talk about the Circular 230. The Circular 230 sets all the rules that must be followed by all tax preparers that are paid. So this will include CPAs, attorneys, enrolled agents, and any individual that receives compensation for preparing a tax return, providing any tax advice, or practicing before the IRS. So if you're representing a taxpayer in an audit situation, if you're helping someone prepare a letter of response to an IRS mail inquiry, that would all be considered practicing before the IRS. The Circular 230 sets forth ethical standards and expectations for all paid tax preparers. Failure to comply with Circular 230 will subject the paid preparer to suspension, disbarment from IRS practice, public censure, fines, and possible civil and criminal penalties, including jail time. The rules for this are very far-reaching and complex. All paid tax preparers must obtain a tax preparer identification number, and this must be renewed annually. And this helps the IRS keep track of what preparer is filing which tax returns. Preparers that are not CPAs, attorneys, or enrolled agents must pass competency exams and annually obtain continuing education. Of course, CPAs, attorneys, and enrolled agents already must earn continuing education credits to maintain those licenses. Some of the basics of Circular 230 and their rules for ethics and standards are that all paid preparers must sign all tax returns that they prepare, provide a copy to their clients, return the records to their clients, and in this case too, records must be returned to clients even if the client doesn't pay for the service. You don't have to provide the tax return that you've prepared, but you have to return all the original records to the clients. Exercise due diligence and best practices, disclose non-frivolous tax positions, notify clients of any errors on a client return. So if you're reviewing prior tax returns for a client and you notice that there is an error on that, you must notify the client even if you did not prepare that tax return. Provide information to the IRS. If the IRS inquiries into a return that you've prepared, you must answer them on a timely basis and with true and correct information. And you also must inform a client if the client made an error. So if the client gave you some wrong information for the tax filing year, you need to inform that client and also let them know what the ramifications of that error could be. And also, Circular 230 says that paid tax preparers must not take a position unless it has a realistic probability of being sustained. So, as you will see as we go through this course, there are some areas where the tax law can be a little bit gray. So, you really have to decide what kind of gray area you want to be in. If you want to be a little bit more in the black than in the white, to use that example, to decide what area of realistic probability that you want to stand on. Paid preparers cannot charge a contingent fee. So before the Circular 230 rules applied to all paid tax preparers, there were some tax preparers out there that would charge a fee based on the amount of the refund that was received. Well, they can no longer do that. You cannot charge an unconscionable fee. You cannot delay any matters with the IRS. You cannot cash an IRS check for a client. So you can't have the client give you their IRS refund check and then take your earnings out of that check and then give the rest of the refund to the client. That's no longer allowed. You cannot represent a client if a conflict of interest exists. So if you have a client that is married and then they end up divorced, in most cases, it is not recommended that a paid preparer represent both individuals at that point because there may be a conflict of interest that exists even if that taxpayer is not aware of it at that time. And also a paid tax preparer cannot make any false or fraudulent statements.